Welcome to Catalyst. I'm Madison Mills. We're 30 minutes into your U.S. trading day. Let's get you 3 catalysts we're watching this hour. First up, a relief rally underway on Wall Street as President Trump puts some technology tariffs on pause. How long can the optimism last? We'll discuss. Plus, Netflix gears up to report earnings this week, but can the streaming giant maintain its lead in the competitive space? And we'll look at how you can invest in space as the first ever all-female crew heads to space on a Blue Origin rocket. Half an hour into the start of U.S. trading, let's get a check on the markets. Taking a look at the major averages, I've got some green to report for your screen here. You've got your S&P 500 up a little over 1%. Your tech-heavy NASDAQ carrying the gains up about 1.3%. I should mention information technology, the biggest gainer in the S&P 500 right now, but every single sector is currently in the green. Tech and financials, the top 2 performers at the moment. Let's flip it over, though, to the bond market, which has been very interesting to monitor as of late. We do have yields finally coming down just a bit, perhaps seeing a little bit of a bid cut in treasuries, perhaps some investor demand coming in as we get a little bit of clarity on what negotiations might start to look like from the Trump administration when it comes to tariffs. Of course, still awaiting more certainty to that end. But finally, let's take a look over at Bitcoin here. Bitcoin moving to the upside, up just about 1%, barely hitting that number, and up over $84,000 as well. Well, I do want to bring in Thomas Hayes. He is the chairman and managing member of Great Hill Capital, an equity manager based servicing accredited investors and qualified institutions. He also has a weekly podcast called Hedge Fund Tips with Tom Hayes, where he shares his market insights. And he's going to join me as my guest host for the hour, answering my questions, the audience's questions, and of course, asking questions to some of our guests. Tom, great to have you in.
Thanks
really
for having me, Maddie.
It.
Happy to be here.
So we were just talking about how you do a great job of getting questions in from your audience on your podcast and answering some of those questions. What would you say is the single biggest question you've gotten over the last week or two?
Well, I think people are a little bit concerned about the uncertainty of the tariffs. How long is this correction going to last? When are the lows in? And I think this time it's a little bit different than people worried about the great financial crisis, people worried about the tech wreck. Is this going to continue to cascade? This is man-made. This is not a function of multi-year buildups like you saw in the late 90s with the tech exuberance. It's not a function of excess in the housing market like you saw with the great financial crisis. This started with a tweet. It could end with a tweet. One day you could wake up and you see this beautiful tweet that says, I just got off the phone with Xi Jinping, and the market rallies. 2 analogs I'm looking at, Maddie. First and foremost was Trump 1.0 trade war. We had a 20% correction in 2018. It took 4 months to recover to new highs. And then if we get a little more volatility with all the negotiating, we go back to 2011 and look at the European debt crisis. We have some debt rumblings here with U.S. Treasuries. That took 3 months, and it was extremely volatile. However, once you nearly touched that 20%, the bottom was in. So we're pretty sanguine and pretty constructive to buy stocks at these levels.
And are you suggesting buying stocks kind of across the board, or are there certain areas investors should look at more than others?
Well, I think it's what you want to get in terms of return. So we look for some of the beaten down sectors because we want to get excess return over time. One of the groups that we're looking at is home builders, believe it or not. You can't give them away right now, but we like a gentleman named Brad Jacobs. He wrote a book, How to Make a Few Billion, and it's useful because he actually made a few billion, and he's put $1 billion of his own money in his new project called QXO. This is a building supply roll-up play. If you had invested with him in the past, whether it was United Rentals, if you put $1 million in when he got involved in 1997, you made $79 million to date. If you got involved with XPO Logistics when he got involved, he put $150 million in 2009, you would have made something like $160 million, 160x. So we want to bet with him because the trends are there. You know, as a millennial, everyone's looking to buy houses. They're waiting because rates are high and there's not enough supply. There is a 4 million unit shortage. And as we know, Trump is going to open up federal land. So not only do you get your starter home from KB Homes, you get an endangered elk in your backyard free of charge. But the fact of the matter is supply is coming online. He's going to benefit. And he started off with a company called Beacon roofing. Everyone needs a roof. When your roof is leaking, it's a non-discretionary expense. You don't think about, should we plug the roof? We replace the roof immediately.
Yeah.
He bought it at 10 times EBITDA. He kind of paid up, but he's going to add technology as he always does and double EBITDA over the next few years.
And I know another name that you're looking at, CRK, I believe?
Yeah, Comstock Resources.
Yeah.
Well, guess what? Not only do we have negotiations with China, we have negotiations with Europe. And what do we want to sell Europe? We want to sell Europe our LNG. And Comstock Resources is controlled by Jerry Jones, who also owns the Dallas Cowboys. He's an oil and gas legend. He owns 70% of the stock. We got involved around $9. It's doubled. However, if you look at proven reserves of this company, they're worth about what enterprise value is now, but the real value, the real unleash is unproved reserves. They've got over 15 years of drilling that's not recognized in their financials because they're only required to report PV10. So we think from these levels over the next 24 months, this stock can not only, it's already doubled since we started talking about it. We believe it can double one more time over the next 12 to 24 months. So we love the LNG play. We know Europe is going to start taking a lot more of our gases in exchange for tariff mitigation, and it'll be a very good thing.
All right, 2 stock picks for you from our guest host, Tom Hayes. Tom, you're going to stick with us for the hour. Appreciate it. Thank you so much. Well, President Trump's tariff policies got a little more confusing over the weekend, leaving investors once again uncertain about the market outlook. Our next guest has sectors that are currently offering safety and also has ones to avoid. We are joined here by Eric Bayridge. He is Sound Income Strategies Co-Chief Investment Officer. Eric, great to speak with you this morning. You say that you have to stay in bunker stocks. It feels like what a bunker stock is keeps changing in this environment. How are you defining that right now?
Yeah, actually, I agree with Tom. You'll make more money buying the bombed out areas than the bunker stocks. But for our investors who are mostly retirees that want income, we stay in the utilities areas a little more staples, just because there's less volatility and more income. But you should always look at the areas that are getting hurt the most for the biggest upside. Right now, I was just talking about stability, areas where it's safer for people and they can sleep at night.
And talk to me then about the most beaten up area of the market in your view on a sector basis. Which one is the most attractive?
Well, attractive and beaten up aren't necessarily the same thing. I think the materials are getting hit the worst, and they have the potential most upside. But remember, as people slow down their order rates to build goods, one of the first areas that gets hit are materials and also energy. We saw oil prices break $60 on the downside. That's going to have significant ramifications if there isn't a rebound. It's a function of both OPEC reconsidering people who have violated their agreements and also demand slowing down, partially due to this uncertainty. So those areas are the two most affected and most at risk and potentially have the most upside coming back.
Tom Hayes is still here with us. Tom, you had some similar thoughts to Eric on that front. Do you have a question for Eric?
Yeah, I absolutely agree with you. On the materials side, absolutely bombed out. We're looking at, we kind of share an affinity here. I can tell you have a value tilt to you. We're looking at Albemarle, for instance. They got $3 billion of excess liquidity. Are there any materials names that you're looking at, Eric?
Well, we own a bunch of them. One that I really like that a lot of people don't because of they're afraid the dividend will be cut is Dow Chemical, which is one of the best companies in the world. Unfortunately, they have had their, and Lyondell, a similar company also in plastics, have seen their demand come down a bit. But I think over a long period of time, those are two companies that you definitely want to own. They're both high yielding stocks, and they have substantial capacity for rebound, both in their margins, volumes, and earnings, as well as, of course, cash flows.
Yeah.
So those are.
No, I'm sorry. I just want to get one more stock pick from you because to that end, Eric, you talked about Corebridge as well, and you're not the first investor who's come on talking to me about how they like annuities right now. Can you tell me a little bit more about that name?
Yeah, Corebridge is basically the spin out from AIG that's focused mostly on annuities and life. And the stock is extraordinarily cheap, partially because of the overhang. AIG still owns over 20%, and partially because people don't know how annuities are going to do. They've been extremely strong over the last couple of years as interest rates have come back up and people want to buy annuities where they had avoided them when interest rates were low. But we see them continuing to benefit from a flight to sort of safety. So Corebridge trades at a little bit over 5 times earnings. Pure life companies typically trade closer to 9 times earnings. So there's tremendous scope for multiple expansion. It's generating double-digit earnings growth. So there's a combination of both the earnings growth and the multiple going to a normal level, we actually think the stock can double over a 2-year period. It's just a matter of them proving out that they can continue to deliver the goods. As any company that you've seen spins out, you see some moving abouts in their accounting numbers that is crystal clear. As that stabilizes, it's going to become a safer investment for people and I think a better performer.
Eric, I got to know about ADT. This thing has been a value trap forever. Before it went private, now since it's gone public again. Give me the growth story. Why is this thing going to come out of this range? Why is this not going to be a value trap? I want to believe. Talk to me, Eric.
That's very easy to sell ADT now because they sold their commercial business. They deleveraged the balance sheet and their earnings are growing now. Their margins have expanded from the mid-teens to the mid-20s. So you have about 5% top line growth, and you're going to have double-digit earnings per share growth. You're getting almost 100% free cash flow to earnings, wow. And they're buying back stock. So you've got a few catalysts. You have a relationship with State Farm, which is giving policyholders a discount to go with ADT to have an alarm system. And you have the Google partnership, technology platform that people like and they're adopting for smart homes. So you see a lot of different things coming together at once. The balance sheet is fixed, their business is growing, they're generating tremendous free cash flow, and they're deleveraging, and plus the overhang from the LBO is going away. So this is another situation where you get a decent yield, 2.9%, you get double-digit earnings per share growth, and you get a multiple expansion. It's currently trading at 9 times earnings. Normally a subscription business like this will trade at twice that multiple.
Fantastic.
All right, Eric. Thank you so much. We got to leave it there. Thank you. Coming up, we're going to take a closer look at some of today's big stock movers, including an incoming litmus test for luxury retail. That's next.
Every investor has heard some version of the old adage, you can't time the market. But as it turns out, the days and times you invest can have an impact. I'm Jared Blickery, host of Stocks in Translation. So let's jump into this. First chart is the S&P 500 going back to the beginning of the last bull market, and currently we're technically still in it. And we can see that in this white line that I'm outlining right here. And moving with it, I've divided the day into 2 different periods. The regular trading hours, which is 9:30 to 4 p.m., and that's in green. And you can see it was going up pretty closely with the overall market until about the third quarter of last year when it started trending down. In blue here, I have the overnight market. So this is 4 p.m. till 9:30 a.m. the next morning. And this is important because the overall market tends to follow the direction of the overnight market more. Why would this be? Because there are 17 and a half hours in the overnight market, and there's only 6.5 in the regular trading hours. So what's interesting here is the blue line was following the regular market, but then they both took a nosedive, and we saw a lot more event risk coming out overnight. And that's typically what happens, is you see a lot of news occurring outside of the normal trading hours, and then they get priced in during the day in very volatile pricing cycles. So here's another chart. I still have the overnight price action, and here it's in orange, but then I've broken down the regular trading hours day into 3 different components. In white, we have 9:30 a.m. to 11:30 a.m., so that's the first 2 hours of trading. Then we have a lunch period, the middle 2.5 hours of the day, and then finally we have the 2 p.m. to 4 p.m. And what's interesting is I noticed that the regular trading hours, as I just said a minute ago, were trending down since about the third quarter of last year. And meanwhile, the lunch period stayed kind of quiet, and then recently it jumped up. It's a little bit hard to see because there's a lot going on in the chart, but suffice to say, the biggest gains of the day should not be made during the illiquid hours of the lunch period. So that's just kind of an anomaly, and it just speaks as to the random price action that we're seeing. This is an event-driven market, and it's not operating according to the same playbook that the rest of the bull market going back to 2022 was operating on. I'm going to close with this chart. This takes a different look. It divides the trading epoch into days of the week. So we have Monday, Tuesday, Wednesday, Thursday, Friday. And this goes back to the beginning of the year, by the way. What stands out is Wednesdays, they have now jumped up, and that's because Wednesdays was one of the best days ever for the S&P 500. So you might think, well, Wednesdays are great now. Not necessarily. I want to reiterate, this is an event-driven market where a lot of the market moves just happen to coincide with the timing of all these news events, and that would be the purview of the President of the United States who's making all of these announcements. Back to the chart, Thursdays are looking particularly bad, but that's just because we had 2 Thursdays in a row that were actually pretty bad. In fact, some of the worst days that we've had since the pandemic. The other days looking kind of sloppy as well. So I guess I'm going to close here by saying this isn't really an invitation to time the market based on what I'm telling you. It's more of an indication that things have really changed, and to get back to normal, we're going to have to start seeing some participation in the overnight pricing action that's favorable. So we want to see the market gap up in the morning and ideally continue that direction up through the end of the day. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. It's now time for some of today's trending tickers. I'm still joined by Thomas Hayes, Great Hill Capital Chairman and Managing Member. We are watching LVMH, some of the U.S. metal names, and Sony this morning. First up, luxury retailer LVMH, the parent company of Louis Vuitton, Tiffany & Co., and Sephora, among others, reporting earnings after market close today. Now, investors will be listening closely for any comments on President Trump's tariffs. It is the first major test of luxury retailers under the second Trump administration, with analysts from Bernstein estimating the luxury sector could shrink 2% in 2025, though you can see right now shares of LVMH moving to the upside. Thomas, we were just talking about some of the regulatory pressure on LVMH, but when it comes to their exposure to China, at least to the Chinese consumer, they could be a beneficiary.
Yeah, there's no question about it. The Chinese government has explicitly stated they're going all in on massive consumption stimulus for the Chinese population to offset any impact from the Trump tariffs. So LVMH is going to be a major beneficiary of that. If I look at my credit card bill every month, 10% is probably Sephora from my 10 and 12-year-old girls. They spend all their free time at Sephora. So LVMH, I think you have to start to look at these companies that benefit from Chinese consumption, because I think the government, we've waited for this China recovery for 2+ years, and I think they've held back this stimulus because they were anticipating the possibility of tariff friction, and this would be a way for them to offset it and to continue to grow. Alibaba will be a major beneficiary from massive consumption. And the Chinese government has explicitly stated, we want to get our people to our economy to 70% consumption within 10 years. That is a huge stretch. So companies like this have a long secular tailwind. We'll have short-term volatility and bumpiness, but on red days, and there's going to be opportunity to buy really great companies.
And we should mention, just for the audience, it's really interesting to see China kind of do a U-turn on stimulus, because the government has been very anti-stimulus, obviously didn't offer it during COVID, and now we're hearing them come out and offer this stimulus potentially off the back of these tariffs. So certainly a U-turn from the government there. But let's go next to TMC. It is a metals company and rare earth miner. MP Materials also rising after a report that President Trump is planning a stockpile order. The Financial Times says Trump is drafting an executive order to stockpile deep-sea critical metals in an effort to counter China as the U.S. seeks to become self-sufficient with these assets. So let me give you a little bit more context here. China saying that they are no longer going to be able to export some of these rare earth minerals. That is just the latest retaliatory move from China when it comes to the trade war. And then you have President Trump firing back to the degree that he can, saying, okay, well, we will just start stockpiling what we have available. But as you know, Tom, obviously these are really critical minerals. They go in the likes of motors and cars, obviously chips for phones as well. So it's something that we do need, and it's something that the administration is focused on.
Yeah, there's no question. President Trump believes he holds the cards, but China has one major card here. When you look at a company like TMC, it's an $800 million company. So how much can you stockpile based on their current production? I think this is going to help us get to a sensible place with tariffs, a reasonable agreement where we get more than we had, China gets less than they had, we kind of bridge that surplus. And I think embedded in this, what we're going to find, ultimately it's going to come down to a reval of the currency relationship, Chinese taking the yuan up further to kind of balance that imbalance. And we won't have to put such pressure on tiny companies like TMC to stockpile rare minerals that China has in abundance.
Yeah, certainly a smaller company when it comes to the ones that we talk about here. But let's end with a bigger firm, Sony, announcing price hikes for its PlayStation 5 console across Europe, the UK, Australia, and New Zealand. The company citing the, quote, challenging economic economic environment, including high inflation and fluctuating exchange rates. The PS5 Digital Edition will now cost nearly $570 in Europe and the UK, an increase of 11% and 10% respectively. And there you can see the shares moving to the upside alongside the broader market by about 2%. Is this just the beginning of price hikes that we're going to start seeing more broadly across the globe?
Well, it must be an amazing franchise to have that pricing power and to say, we are raising prices on our PlayStation because it's a challenging environment. In other words, we don't want to do it, but you need our product so much that even though you're challenged, we're going to raise the price and we're going to do just fine. So you may see some of that across the board. We'll know more in coming weeks and months as this thing gets resolved country by country. You had Hassett on earlier this morning talking about maybe some package deals, getting a bunch of countries done at once. You start getting that stuff hit the tape, and this bottom in the markets could be durable. Let's see how it comes in coming days and coming weeks.
Let's certainly see it. It is fascinating. I've spoken with sources before who've told me that these consoles, these video game players, there's not like an off-brand version, so they do have a lot of that pricing power. To your point, Tom, you're going to stick with us for the second half hour of our show. And by the way, you can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're going to be taking a look at how companies and the Fed are responding to the White House's evolving trade policy. That's next. CEOs voicing varying degrees of concern over President Trump's tariffs as second quarter earnings season kicks off in earnest. Goldman Sachs CEO David Solomon warning of a markedly different operating environment. Meantime, DHL CEO Tobias Meyer telling Bloomberg companies are, quote, a bit tired of the changes. Joining us now with more on the president's trade policy, we've got Andrew Siciliano, KPMG Trade and Customs Global Practice Lead. And we also have Marco Casaraghi. He is Evercore ISI's senior economist and strategist. Thank you both for being here. I also want to bring in my co-anchor for the hour, Thomas Hayes, Great Hill Capital chairman and managing member. He will be joining us for the interview here. So, Andrew, I want to kick it off from you. What are you hearing from CEOs at this moment?
It's been tariff whiplash lately, and what companies are really doing is that not looking at this pause or timeout as just a pause or timeout. They're looking at it as an opportunity to build a resilient trade strategy. So that's what companies are doing. They're kind of going from reactive to readiness, getting ready for the next wave.
And Marco, come to me on that. I saw a stat this morning that our executive producer flagged. More than 60 CEOs expect a recession in the next 6 months, according to an industry group. Are you seeing that?
Good morning, and thank you for having me. So yes, I think the last week partial retreat on reciprocal tariffs has somewhat reduced the probability of a recession, which remains elevated by probably around like 35, 40% as of now. In our central case, we expect growth to slow down to around 1% by the end of the year, and core inflation will be around 3.3%. So not an outright recession, but the economy is definitely weakening.
So I have a question for Andrew. What do you see CEOs doing? What's their strategy? Are they saying, we'll just wait it out and eat it for 3.5 years? Are they going to stand up factories in the US? And then what happens if policy changes 3.5 years from now? There's a lot of confusion. How do you play that? And do the big get bigger as the smaller players just go out of business? Or how are you thinking about it? How are CEOs thinking about it from large companies to small companies?
So there's still a lot of uncertainty until this plays out, right? So in terms of developing a resilient trade strategy, here's what companies are doing. One, they're finally getting access to all their trade data. If you don't have your trade data to do modeling, you're flying blind. So that's one thing. We're seeing companies look at the people that are in charge of trade and customs and elevating them to senior positions, VPs, directors, chief trade officers. You need someone in charge of the function, because customs went from back office to boardroom in a matter of months, right? And then lastly, just optimization of trade strategies. Companies are looking at every single strategy they can and really focusing on making sure they're doing it compliantly. So that's been the focus right now, those three pillars, getting ready in case the reciprocals come back in the same way they did. They could be less, they could be more. We just don't know yet.
Yeah, we just don't know. And Marco, I want to go back to you on this because we are, as I mentioned in the intro, really in second quarter earnings season now, truly kicking off here. To what degree do you think companies have the resilience to be able to still win over Wall Street this earnings quarter, given the uncertainty, Marco?
Yeah, I think, we have seen very large moves in the stock market, in general in financial markets last week. And I think that when that happens, we tend to focus on what happened today and what will happen tomorrow. But I think it's important to not get trapped in this narrow day-to-day narrative and take a step back to look at the broader picture. And if we do that, we will see that economic uncertainty has jumped much higher than we expected just a few months ago. And it's probably here to stay, as Andrew said. So even if tariffs go down this week because of some other exceptions or some deals between the US and other countries, it will be very difficult for markets to believe this is the end of uncertainty about trade policy. And even in that case, uncertainty could simply extend to a different type of policy, like what will happen to the fiscal deficit.
Right.
And so this means we will continue to face this pervasive sense of uncertainty, which is a big obstacle for firms and households and in general for economic prosperity.
And Tom has another question as well. Tom.
So Marco, when do you think we're going to see the pivot from the uncertainty of tariffs to the opportunity for growth with tax cuts, deregulation? In other words, package this up like Kevin Hassett was talking about this morning, maybe packages of countries all at once, put the pain behind us and now focus on growth, deregulation, tax cuts, et cetera. When do you anticipate seeing that pivot?
It's very hard to tell, right? I don't think, as I said, I don't expect uncertainty to dramatically decrease in a very short time. I think uncertainty is here to stay. And I would not be so optimistic about, seeing a lot of good impact on markets and growth in general once we move away from trade policy uncertainty to fiscal policy. Because what we have seen last week, for example, is that we have seen that global investors have probably reallocated away from the US to some extent. We have seen the dollar weaker and yields higher, which is something that typically happens in emerging markets, not in the US. So talks about massive tax cuts may not have such a big positive impact on the economy as many people think.
Are you shifting your allocation to ex-US, or you haven't made that decision as a firm yet?
We haven't made this decision yet. I will not talk about specific portfolio allocation here, but there is a sign that something may have changed. What we saw last week in the treasury market and in the dollar is something that hasn't happened in 30 years, except for the week when Lehman Brothers went down in 2008. So we are talking about very unusual moves in the market. And what we're seeing is, as I repeat, is that there is some stress in the treasury market. People are moving away. Global investors are probably seeing treasuries less as a risk-free reserve asset, as more in general as a risk asset. And that is as an implication, because this means the US may eventually, not tomorrow, but gradually lose its so-called exorbitant privilege.
Right.
They basically allowed the US to run unsustainable fiscal policy for many years without paying the price.
All right, Marco and Andrew, thank you so much. We're going to have all your markets action ahead. Stick around. You're watching Catalysts. Netflix is set to report its first quarter results on Thursday after the market close. Here's what to watch in the streaming juggernaut's results is senior reporter Alexandra Canal. Hey, Ali.
Hi, Maddie. Yeah, we have Netflix kicking off earnings season for the media giants, and all signs point to another solid report. As a reminder, the company will no longer disclose subscriber figures. In fact, this will be the first report that investors will not be receiving that metric, which means the focus this time around, it's going to be on revenue growth. And for the first quarter, we do have a double-digit gain expected. Netflix guided to an 11% surge for top-line sales. Average revenue per member, otherwise known as ARM, that should also see a boost from recent price increases in the US, UK, and Canada, along with steady subscriber additions, although any commentary on churn from those price increases will be closely watched on the call. Now, all of that should trickle through into further margin expansion, which the company is confident it can achieve. Currently, Netflix is projecting margins of 29% in 2025. That's up from last last year's 27%. And finally, I want to quickly mention tariff impact, which is likely to affect the overall media business on the advertising side. According to an estimate from MoffettNathanson, tariffs could deliver a $45 billion hit to companies like Meta, Snap, Roku. They all make the majority of their money through ads, so they're the ones that are going to be most exposed here. But we could potentially see that trickle through into the TV and streaming side more prominently the longer this goes on. It's also possible that production costs will rise, and there could be retaliatory measures by other companies to limit the shows and movies foreign users can screen. So any further guidance or commentary on tariffs, what management is specifically watching out for, that's also going to be something to look out for in this report. And as we've been talking tariffs, we've also seen this dramatic decline of the US dollar, and that could actually be a foreign exchange tailwind for Netflix this quarter and for the future. We've seen a strong dollar negatively impact earnings previously, so perhaps potentially one positive catalyst here from all of this. But again, Netflix reports earnings after the bell on Thursday. Certainly a lot to look out for.
Certainly a lot to look out for. I know you'll be covering it all for us, Allie, so thank you so much. Can't wait to talk to you about it more. But here, we're going to continue the conversation because Netflix sees big growth in its ads business. The streaming company's ad-supported plan made up over half of new account signups in its fourth quarter. Netflix execs have said that 2025 will be the year its ad business transitions from a crawl to a walk. So what does the ads push mean for the future of streaming? Here to discuss, Melissa Otto, S&P Global Visible Alpha Head of TMT Research. Melissa, talk to me about Netflix's ability to scale their ad revenue. Just how much runway is there?
Thanks for having me. It's great to be here. In tech, it's always exciting. There's never a dull moment. In terms of the ad-supported business, this is an area of their fundamentals where we're seeing a lot of debate based on Visible Alpha consensus. Those FY 2027 estimates that are currently baked into the valuations range from $3.5 billion to $17 billion. So you've got real bulls and bears out there based on what their assumptions are around ads, the ability for Netflix to actually scale that business, and also the macro backdrop.
And talk to me about that macro backdrop. Just how exposed is Netflix? Because I've had sources say this is one of the most recession-proof names out there. Do you agree with that?
Coming into this quarter, based on Visible Alpha consensus, we have not seen their estimates move. The consensus is the same that it was last quarter coming into this quarter, whereas we have certainly seen that for other technology names in the space. In particular, we've seen Apple. Their estimates have come down. Consensus has come down. And so, you know, when I compare them, maybe it's the size of the exposure, the magnitude of the exposure, and what the rhetoric has been around the actual business model and space.
So Melissa, coming into earnings, are you comfortable with the valuation, 37 times forward? You got a $400 billion enterprise value on $7 billion of free cash flow. You know, that kind of compares to Disney, for instance. They've got $8.5 billion of free cash flow and maybe $190 billion enterprise value. Oh, and by the way, you get the parks and you get the experiences and you get the cruise ships for free. Just talk about what that means in terms of exceeding expectations, and now that they're not reporting subscribers, and you've seen Disney kind of stall at 178 million subscribers, and Netflix maybe stall at 300 million subscribers. What are your thoughts on the relative value?
I mean, it'll be interesting to see how the fundamentals actually shake out and what kind of commentary we actually get from senior management. They're going to guide the market. They're going to give us that strategic conviction in terms of whether we believe the bulls or the bears, like whose assumptions do we go with? Yeah. And in terms of Disney, we can't forget that they have a substantial amount of their business in the Far East. Mm-hmm. So they are also exposed. Mm-hmm. And, you know, I think net, it'll be interesting to see who's the bumper in this. Yeah. And that's really going to dictate what the right valuation is and where the trajectory of the price is going to go.
I do want to circle back to Apple, which you mentioned, obviously whipsawing a lot off the back of a slew of announcements, both the idea that they were going to be excluded from the worst of tariffs, but then we have sectoral tariffs coming. How are you modeling the net effect of that on Apple moving forward? If we do get these sectoral tariffs, is Apple in as good as a position as investors are acting like it is today?
I mean, it's a crazy backdrop at the moment. Forecasting anything it's got to be Monte Carlo. You know, give us a range of scenarios, and we're going to try to figure out which side it's on. I think this earnings season is going to be critical for these large bellwether companies. CEOs really need to shine and show the market what they're doing to navigate this, how we need to think about it, how the overall street estimates out there need to capture this. We can't have estimates all over the place. There needs to be some sort of conviction that consensus is accurately pricing in what the market is dictating.
Yeah. All right, Melissa, we got to leave it there. Thank you so much for making the time. Appreciate it.
Thank you.
Coming up, Blue Origin just completed its 11th manned space trip. We're going to dive into the winners and losers of the space race next on Catalyst as you watch the all-women fleet on your screen. Stick around.
Good luck and Godspeed, ladies. We're cheering you on from
Let's
planet
launch
Earth.
this
Thrust
rocket.
termination system is armed. Command engine start. 2, 1, ignition.
That is Jeff Bezos' Blue Origin New Shepard rocket taking off with the first all-female crew since 1963. The flight launched just after 9:30 a.m. Eastern, orbited in space for 4 minutes, and touched back down around 9:40 a.m. The 6 women who completed the voyage include pop star Katy Perry, broadcast journalist Gayle King, Bezos' fiancée Lauren Sanchez, former rocket scientist Aisha Bowe, film producer Carrie Ann Flynn, and scientist and sexual assault advocate Amanda Wynn. This is the 11th manned flight for Blue Origin's New Shepard program. The rockets are designed for an 11-minute journey going past the Cameron Line, which is the internationally recognized boundary of space, allowing the passengers to experience weightlessness and see Earth from a distance and then return fully autonomous with no pilot. Some have criticized the launch as an advertisement for Bezos and Blue Origin. The company does sell space flights for tourists, the exact price not advertised, but it does require a $150,000 deposit. While Blue Origin just completed its 11th manned trip, SpaceX has been busy launching satellites and rescuing stranded astronauts from the International Space Station. Those astronauts were not able to return home on their original Boeing craft. Amazon now preparing for the inaugural launch of its own satellite project. So amid all the competition, where can investors find the most opportunity in the space race? Here with more, Andrew Channon, the co-founder and CEO of Procure AM. It is an ETF company focused on the space sector. Andrew, great to have you back with us this morning. Obviously, Blue Origin getting a lot of attention this morning, but where do you think retail investors should be looking for the most opportunity in space right now?
So it's been a really interesting, a lot of developments for this industry, really going back to May last year, where we started seeing a lot of communications names getting buzz. And if you look back at the size and the growth of the overall space industry over the last many decades, communications has really been the largest portion of the revenue generator for the space industry. And so while many people don't predict that to change, there are many things that are occurring, especially with launch, that are allowing a lot of entrants into this industry and allowing a lot of different companies to access space at much lower costs. So we brought out UFO actually 6 years ago. We celebrated our 6-year anniversary last Friday. And we've seen tremendous changes for the space industry over that time. And it's a way for investors to get exposure to roughly 35 publicly traded companies from around the world, specializing in all different areas of the space industry.
Yeah, and I know you have that ability for investors to get into these ETFs that allow them exposure to several dozen of these space names. But if you take a look at the Yahoo Finance platform, we have a new tool that allows you to track private markets, and you can see SpaceX, the #1 name on that list due to its estimated valuation at around $382 billion. Andrew, should investors who are interested in space just go in on a name like SpaceX, or should they be diversified even within the relatively niche sector?
So SpaceX is a really kind of different story, especially, obviously they're a private company. And although there's becoming more ways to gain access for private companies, it's something that we track, even though the fund doesn't currently own any exposure to SpaceX. But those that are getting access, either direct ownership in it or via SPVs, in many cases, it can be very expensive. So it's not just paying for access to it, but in many cases there's entry fees, there's management fees, performance fees, and all different types of fees layered on top, because there is a lot of interest in getting exposure to names like SpaceX. For most investors, though, being able to invest in publicly traded names or ETFs that focus on the space industry may be a way for them to get exposure and also, in some cases, benefit from the rising tide that for the space industry has been SpaceX in technologies like reusable rockets, which has significantly reduced the cost of accessing space, which has been a boon for many other companies that are trying to get involved in this new kind of new space race that we're seeing.
And Andrew, my guest host, Tom Hayes, is still here with us over at Great Hill Capital, and Tom has a question for you.
Yeah, Andrew, so reusable rockets is the name of the game. What's your level of confidence? Obviously, Falcon 9 has done thousands of missions up there and brought satellites up with no problem whatsoever. Then you've got Boeing with Vulcan. They've had 2 trips, so that's a positive. And then you've got Blue Origin with New Glenn just doing 1 trip. How do you expect that competition to accelerate over the next couple of years? And kind of what are your heaviest weights in the ETF that are playing the space theme?
Yeah, so launch is extremely important. And yes, it's been great for getting costs down, but you do have more players coming out. You look at what Amazon is doing with Project Kuiper, and they didn't just sign up Blue Origin to be a launch provider to get their satellites up into space. They actually contracted 4 different companies for, I believe, about 80 launches scheduled over the next several years. And so, even being able to send things to space, it's really important to make sure that you have a diversified list of launch providers just in case there's any mishaps at one company or another. And so that's kind of diversifying across the launch industry, but then you have different types of launch companies. So, for Project Kuiper, they're planning to launch about 3,200 satellites. About 1,600 of them need to be launched in about a year's time. And so, you need to have bandwidth and plenty of supply in launch to be able to get that amount of satellites up. SpaceX has, Starlink, which has been a rival, and they have now more satellites in operation than there were total satellites in operation when we first launched our fund 6 years ago. So we've been seeing a tremendous amount of companies sending satellites into low Earth orbit, and it's happening rapidly. So, in our fund, we have companies like for launch, you have Rocket Lab, another name that we hadn't mentioned, doesn't have any of those Project Kuiper launches, but they're working on their next generation rocket as well, so they can send much larger payloads up. We have names like Lockheed and Boeing, which form the United Launch Alliance as well, which is a launch provider.
All right, Andrew, we got to leave it there. Thank you so much for joining us. Really quick, Thomas Hayes, want to get your thoughts. Final 30 seconds of the show. We're still seeing green on our screen across the major averages. How much can investors trust this relative optimism today?
You can't trust it on a daily basis, but focus on what you can control. When the market's marked down like this, if you focus on buying high quality companies that are marked down, one of the companies we were buying last week aggressively was Disney at $85. You don't have to think hard about Disney. It's down from $200. Over the next few years, it's going to recover. Tariffs or no tariffs, it's going to be okay. Boeing was a company we were adding to. It got down to $129, down from $350 some odd dollars. This is a duopoly in the aircraft space. So if you buy great companies and you have a long-term view, 12 to 24 months, you're going to do great out of this opportunity.
To that end, NVIDIA was under $100 a couple weeks ago as well. So certainly something to keep in mind. Thank you so much, Thomas Hayes of Great Hill Capital, for joining us. Appreciate it. Coming up, we've got wealth dedicated to all your personal finance needs. Brad Smith has you for the next hour. Stay tuned.